Hi, welcome to this section on private equity. Now, private equity investments are very well known, and we all hear about some or the other private equity transaction in financial press, even every now and then. So, private equity investors are funds who kind of take money from limited partners who are essentially the investors in the fund, and they deploy the money in investments in companies to basically generate returns. So that's the nutshell. But let's kind of dive into what is required for this course. So they either invest in private companies or public companies which they intend to take private. So it's important to note here that it's either the private companies or any companies that are public today, but they intend to take them private in the days to come. So it's both private and public companies which they intend to take private over time. So the companies that they intend, sorry, excuse this highlight. I'm just not used to this tool. So the companies that they intend to take private are public listed companies on exchanges, and such transactions are called LBOs, right? Because you're taking some company private by investing funds, by buying out the current shareholders, and that's generally done through debt in a LBO. And otherwise, some companies private and a private equity firm has interest in buying shares in that. That's a regular private equity deal in a private company. So both of them are there, and then there are other small categories like distressed investment funds who would most likely invest in distressed companies, companies which are close to bankruptcy, have some financial trouble. The existing promoters cannot run it well. They need support of a private equity investor to come and inject that capital required to come out of those tough times, financial times. Then the last one is development capital funds. Now, this development capital funds is also called growth capital, right? And it's a very common kind of private equity investment in developing markets. Where companies are not at scale, consolidation has not yet happened. There are multiple players doing the same thing in the industry essentially, and private equity funds fund some of these players who tend to do well, versus the others. Now we look at some of the private equity strategies. How do they invest in various assets? So leverage buyouts, we discussed that. This is the most common form of private equity across the world, and leverage is the primary, fund. So basically, you have a company. I'll just try to show it to you. You have a company now. So this is the company, say, and you have existing equity holders who are the shareholders, right? So you have your existing equity holders who are the shareholders, and a private equity firm comes in and wants to buy the shares here, right? But doesn't want to take up the whole. And there could be debt also, some existing debt also. So what a private equity firm does is brings along, lenders who kind of buy into this equity along with them. So they invest lesser than the total capital required to buy out the company, and that's how LBO transactions are generally funded. So that's kind of the way it is done in practice, and the way we should kind of look at it. So that's a little bit about what LBOs are. Debt is the primary funding source for a LBO. It can be bank debt, high yield debt, or mezzanine financing. So high yield debt is a risky kind of debt where corporates which don't have a great credit rating, if they issue debt, that's generally in a high yield bond category. Bank debt is regular debt from the bank. It could be term loan, could be lease rental discounting, could be multiple types of loans, construction finance if you have a development. So essentially coming from the bank. High yield bonds, as I told you. Mezzanine financing is very important. So there are two mezzanine concepts in this topic. One is mezzanine financing, which is the type of financing, right? So in this case, it depends on the instrument that is used to finance. And then we look at later in venture capital, we have mezzanine financing structure, which is essentially a timing definition. So you have to keep in mind that this mezzanine financing is a type of instrument, whereas that mezzanine financing is a timing of funding into a startup. So I'll explain to you in detail. So this mezzanine financing has both features of debt and equity. So a debt preference share, they have warrant-like conversion features. So this is not essentially a pure debt instrument, and it's not a pure equity instrument. It basically enables the investors to take advantage of the appreciation in equity value. So basically, the investor is putting in a kind of debt which is subordinate to the high yield debt or the bank debt, but it has features where it can be converted to equity tomorrow. So if the company does really well and the investors see more value in converting to equity than just getting back interest and the principal, they would do so, and that's advantageous, right? And if the company is not doing that well, they can as well stay as debt holders. So it's at the discretion and also depends on the agreement between the lenders and the borrower. But just to tell you the concept, mezzanine financing is somewhere in between debt and equity, has features to convert itself into equity like structure. Two types of LBOs. When I showed you that we are kind of raising debt to fund the purchase, uh, the internal management could do it. The internal management could take control of the company, or there could be a new management being brought in by the private equity funds from outside. So we have MBOs, management buyout, the same management continues. Management buy in, where a new management is brought in from outside and replaces the existing management. Now, private equity funds are in it for money. There is no doubt about it. So they want to generate their return on their moolah, on their money invested. So they would do whatever is legit and possible to do to extract that return out of an investment. A lot of strategies a private equity fund would use. Some of them are listed here. Revenue enhancement. If there are any ways to increase the revenue of the company through private equity's intervention, they would do that. They would try to share insights about the industry. They would try to connect them with possible potential new customers so that the revenue line goes up in the company. Cost reduction, so similar means you're trying to extract more profit out of your business. So if there are any efficiency issues, if some cost can be cut, a private equity investors will help the promoters or the management of the company cut those costs. New management, new incentives. So maybe the old management is not motivated enough. They want to bring in a new management, or they want to give the management more incentives to do well. All these things can be done by private equity investors. They could restructure the business itself. It could mean restructuring the entities. It could mean restructuring the main business itself. It could mean a lot of things. So this is also something a private equity investor could do to extract value out of an investment. And who are suited for LBOs, right? So LBOs are important. So if you are taking on a lot of debt to fund a purchase, what's the most important thing that you would look at in an asset who is a ripe candidate for a LBO? It needs to have high cash flows. So that's the main point, right? If a company has high cash flows, they'll be able to service their debt no matter how high the debt may be. And in LBOs, of course, you are piling on debt. So if you are piling on debt, you need a company with high cash flows, stable cash flows to shoulder that debt, to have a good coverage ratio on that debt and interest. So this is very important and could be asked in the exam. Do keep this in mind. Moving on, few more strategies. Like we discussed LBOs in the last slide. We're talking about venture capital. Now, when does a venture capital invest in a business? Now, a venture capital by the name, is kind of coming in at an early stage of development. They don't come in at a late stage of development. And as you saw in LBOs, you have high cash flows in LBOs. The companies which are targeted for LBOs, they can't be in early stage, right? High cash flows means the company has done really well and it's generating a lot of cash. So this is a completely different segment of private equity investing. This is like startups which are just beginning to grow, and you will see, this venture capital investment segmented by evolution of the startups in the next few slides. Now, they would generally invest in equity, sometimes convertible instruments like convertible preference shares, debt. Convertible debt may also be used for various purposes, right? This is also important. This is high risk and high return business. Now, if you are investing in a company with high cash flows, what are you reducing? You're reducing your risk of your capital not returning back to you. But if you're investing in a company where the business model is getting developed, or it's in early revenues, what risk are you taking? You're taking the risk of your investment not being returned back to you. So this is high risk high return business. Why we say high return is because you come in early, you kind of get a higher stake for your value. Whatever money you put in, you get a higher stake at a startup stage, and then you could make a huge return. So just to give you an example, how venture capital funds operate is that if they have 10 investments and two of them do well, eight don't do well. In fact, if you take this ratio as 22 and 18 also, this two generally makes up for more than what they invested for in these 20 companies in the beginning plus a return. So that's the high risk and high return I'm talking about. Only 2 out of 20, if they do well, they are home with a great return. So venture capital firms do well. They want to identify those two aces in their portfolio, even if they're not able to identify the other 18. If they do more than two, obviously the returns will be much better. So that's the business. It's about choosing the right startup, and it's high risk. So if this is zero or this is one, which is doing well, you are down with your money. You will not even get the principal back or the money that the investors put in back. So this is important to know. High risk and high return venture capitals. Investee companies. So investee companies are essentially the companies that you invest money in from private equity funds. They're also called portfolio companies. This is just jargon parlance, just to know. Now, venture capital funds, the managers are generally on board. I have been fortunate enough to be in a private equity company and serve on some of the boards of some of our investee companies. Now, our key function there is to occupy managerial positions sometimes, that you become a VP finance there, or you become take a high chair there in the finance or the business and the strategy side of business, so that you can help them with strategizing the business better, because you have seen so many investments as a private equity fund. You know what works, what doesn't work. No, not always, but you have a fair idea. If you have had investments in that sector, all the more better you can guide a prospective board to do well. So you basically are on the board. Sometimes you are taking operating chairs at the portfolio company level to guide them to do well. Okay, this is really important. As I was saying, that private equity investments are categorized by the stage of the startup, and there are various stages in which, and I'm talking about venture capital investments within the private equity as such, not just the private equity part. So within the venture capital investments, the investment type is dependent on the stage of the investee company. So the investee company could be in formative stage, a later stage, or a mezzanine stage. So we would just look at what each of them mean. Formative stage itself is divided into three stages. It could be angel investing. Angels are early stage investors, very early stage, idea stage investors. At this time, even the plan is just getting formalized, the business plan. So this money is used to assess the business plan, to test the business plan, and also to see whether there is a market potential for the plan. Right? Are there enough customers for this product? Are there enough customers for this service? Is this going to take off? Are there comparables? All this needs to be assessed at this stage. So the angel investing side, the funds are generally used to evaluate the business. Then there is seed stage within formative stage, right? Seed stage, the funds are used for product development. Now that you have evaluated that business plan is going to do well, there is a market for it, there are customers for it. What would you do? You would develop that product. You would do some marketing. You would do market research. So all that is done at the seed stage. So angel, seed, and then early stage. So this is all in the formative stage. So this is important to know. Uh, this is important to know because some questions may come on this topic. So angel stage, idea stage, seed stage, funds are used to develop the product itself, and early stage. Now the product is developed, product is known, market is known. Now what is the next step? Right. The next step is to produce it, hit the market. So this is the early stage where you produce the product, hit the market, do the commercial sales out of it. Later stage. Now later stage investments, the company is already in production of the product and the sales are happening. Now this fund is essentially for growth. So funds are used for expansion through increased marketing. So you could increase the marketing, you could push the gas on marketing and let the product. Now since we have already tested the product, there is a market for it. There are customers waiting for it. So how do you make the product go to a larger audience? You market it and you produce scale out of your business. Now, finally, this is the mezzanine. Now, I was trying to tell you that how mezzanine financing differs from mezzanine stage earlier. So, this is mezzanine stage where the product is already there, the commercial sales are happening, marketing push has been given, and now the company is slowly moving towards an IPO. IPO is where we are launching our initial public offering, basically, basically making the stock, the shares of this company available to public and raising money from the public on a listed exchange. This is the stage where we need some funding in between, just before hitting the IPO. Now that's called mezzanine stage. Whereas that was mezzanine financing, where the instrument was the key mezzanine financing instrument, which had characteristics of both debt and equity. So this is just before IPO, the period in which you need to raise some funds, that is mezzanine stage. So this defines the landscape of VC investments: formative, later, mezzanine. Within formative, you have angel, seed, and early stage. Now, third type, which here was mentioned, is a minority type, is the developmental capital, which is the growth capital. Now, it's not in VC stage, it's not in a LBO stage. The companies are somewhere in the middle. They need capital to grow. They are having working capital issues. So that's where capital is invested for business growth and restructuring, and firms are financed, which could be private or public. Now here there is another unique type of investment strategy which is called PIPE, private investments in public enterprises. Like you saw in LBOs, the intent is to take the company private. Now in PIPE is a investment by a private equity into a public listed company, but the intent is not to take it private, is to keep it as is, to keep it listed, which is also good for a private equity fund because it ensures liquidity when it comes to exit. You can always sell your investment on the exchange. So this is another type of private equity investing. Now we come to structure and fees. Now this is very interesting. Now what happens is, in a private equity fund, you have a fund, right? I will show this to you in form of a diagram. You have a fund, right? And say this is the fund, right? You have investors in the fund, so they are putting money. Now they are called LPs. These are rich individuals, institutionals who are putting money in the fund, and the fund is investing money into companies, right? Simple. Now these are investee companies, as we saw, or portfolio companies, as you may want to call them. Now what happens is that, where is the private equity fund management in this case? That's the question, right? So there is a company guiding the fund on how to invest, right? Now they are called GPs, or general partners, and they basically help the fund invest this capital. They identify these investment companies, investee companies or portfolio companies, and they charge a fee from the fund to do so, and they employ people. Here your fund managers will sit, right? So that's the structure. These are the investors, limited partners. They are called limited partners because their liability is limited. They are general partners. They invest the money, they guide, they advise, they get fees, and the fund invests in investee companies. Now it will be easier now to look at the left side. So they are structured as limited partnerships. The investors come in as limited partners. LPs who are limited partners commit a total sum. So they commit a basically capital, which is called committed capital. So this is the full amount of capital that the LP is committing. This is a committed capital. Now this drawdown happens on the instruction of this GP. Whenever they find investments worthy enough, they will draw down fund money from the LPs into the fund, and that will be the drawdown amount, right? And it will take roughly 3 to 5 years to identify all the investments and draw down the entire committed capital into the fund, right? And whatever has been drawn down at any particular point of time, whatever has reached this stage, and is ready to be invested or has been invested, is called invested capital, right? Now this is the definition of, and generally drawdowns happen when there is an investment ready to be invested. So generally invested capital is all the money that is deployed here at the invested capital stage, at the investee company stage. Now total fees that is charged by a GP here is made up of management fee and a incentive fee. Now, management fee is a percentage amount of the total committed capital, total commitment, not the funds invested. Please bear this in mind. So, if you are saying to me that 100 million of capital has to be invested, this 100 million will always be used to calculate the management fee, and there will be a percentage applied to it. If I invest this 2 years down the line, also the GP invests 2 years down the line, also management fee will only be calculated to 100 million, even if 20 million has been invested. So percentage of committed capital, and generally in the ratio in the range 1 to 3% of committed capital. This is easy. And incentive fee is basically when a fund makes a profit. Say you put in the fund put in 100 rupee total, and out of all the investments, say that it made 5 investments. Out of all the investments, 4 investments have already returned 100 rupees back, 100 rupees, and the fifth investment returns 50 rupees. Now the fund LPs have already got their 100 back, and this is a profit, right? Fifth investment is giving a profit to the, so sometimes this is structured as 20% of the profit. So GPs get an incentive fee of 20%. This is a normal fee, 1 to 3% management fee on the committed capital, which is this. And this incentive fee is over and above, and it's a percentage of profits, right? So it's that simple. Now what happens is that it may so happen that the funds start selling investments, and the LPs start making profits, right? And they start giving out 20% of the profits. Say if 20% is agreed, this structure is called 2 by 20. Just this is additional information, not part of the curriculum. Now 2 by 20 means 2% management fee, 20% incentive fee. It could be 2 by 30, could be 2 by 40, 2 by 10, whatever, or 3 by 10, whatever. So if the fund has already returned profits, now it has already started giving 20% incentive fee to the GP. But say a lot of losses started happening in the end, in the later investments. So the initial profits are getting eroded because the principal is also not coming back later, right? So what happens, because principal is getting eroded through losses. So there is a clawback provision in some of these LP-GP agreements, wherein the LPs can protect their interest and recover money from GPs if overall they are not making profits. So if they are not making 80% of the total profits, and 20% says up, more than 20% has got paid to the GPs, they can recover that amount through a clawback clause. I hope this is clear. You can read more about clawback clause online if required. This is mentioned as a glance through in the curriculum, but if you want, you can kind of go through this in detail. Now, what's the ultimate aim of a private equity investor? Obviously, they are enhancing the revenues, reducing the costs. They are trying to do restructuring. They are trying to generate returns, That's the end goal, right? They're trying to generate returns. So how do they generate returns? They have to exit what they have bought, right? And the exit strategies include a lot of different ways, and I will discuss them. Average holding period is roughly 5 years. It could be 6 years, 7 years for some funds, but this is general average of most funds. Primary methods, one is a trade sale. So we have to distinguish between a strategic buyer and a financial buyer. A financial buyer is like another private equity investor or a financial firm, whereas a strategic buyer is a company in the same sector generally and has vested interests in buying that particular company to cut out competition, to gain some skills that they don't have in their team, to gain some products that they don't have. So that's strategic because they have a strategic angle to it. They want to cut out competition, they want to add some products. Financial investors are concerned with returns, and that's how you distinguish between a strategic investor and a financial investor. So trade sale is generally to a strategic buyer or a competitor. IPO, taking the company to public, raising money from the public, be listed on the exchange, be bigger than ever before. That's another way of exiting. So when a trade sale happens, company selling shares to strategic buyer competition, the private equity investor also sell its shares to that buyer. IPO also, the private equity investor puts their shares to the public to buy. Recapitalization. Now, sometimes what happens is debt is issued to fund dividend distribution to equity holders. So, since private equity funds are equity holders, a company raises debt and pays back its equity holders. So, it's not a full exit, but you got some return back as a private equity investor in form of dividends. Secondary sale. Now, this is different from a trade sale because this is to a financial investor. Say you are a mid-market financial investor and the company's grown big. You want to sell it out to someone who can hold it longer and is a large cap investor in private equity markets. You kind of sell it to another financial firm, to another private equity investor. And if the company is doing poorly and you see no scope of it returning money, since your hold period is also limited, you have pressures from your LPs to return back money, you can write off the investment or liquidate it if there is no possibility of an exit. That's also one way of closure to your private equity investment. That's why it's a part of the exit. In fact, but there's no return happening here. Whatever is, I think, is seldom returning some part of your invested capital. What are the benefits and risks of PE investing? Benefits is that they have generated more returns than stock markets over the last 20 years, and they have excellent diversification since they kind of have low correlation of returns with traditional instruments like bonds and equity, listed equity, stocks. Now, what are the risks? The standard deviation from the mean is very high, which means that for a lot of people doing well, there are a lot of people losing money as well, right? So standard deviation is high, the returns are more spread out, there's more risk to private equity investing. And the portfolios are not valued every day. A stock is valued every second, less than a second, right? The tick happens on the exchange, whereas private equity investments are valued infrequently, and there is a large or a big chance that you are reporting the wrong valuations, and this could also lead to a wrong standard deviation or a correlation of returns. You could be holding a very risky investment, but since it's valued very infrequently, you could be thinking that, oh, we have got a great diversifier in our portfolio, or we've got a great return producer in our portfolio, whereas in reality it may not be the case. Since you're only valuing it twice a year or once in 2 years, you may be missing out on some important data points. Survivorship bias and backfill bias. Again, these are biases where survivors survive to tell the story, right? All the data, as we saw in benefits, higher return than stock markets. You are basically taking a sample size, and if that sample size only has survivors and all the private equity funds which vanished in, say, a downturn are not there as a part of your data, you are again representing it in a wrong way. So this is also there. Backfill bias is also similar. Backfill bias is like if some fund is in existence for 10 years, but the fund managers only report last 2 years of performance, and they wipe out the last 10 the first 8 years of performance. So you're not looking at the full historical data. So again, backfill bias can skew results. And the most important takeaway is that choosing the right general manager is the most important thing in a private equity investment. It determines the outcome of the investment. High performing managers have consistently done well over low performing managers. So that's very important. Who is picking? Who's the GP? That's very important. Moving on. Due diligence. Now, you need to look at a few things before investing in private equity. Say you are a private equity investor. You need to see what's the interest rate environment, what's the availability of capital, especially if the private equity funds is doing a lot of LBOs, right? Because you need to raise a lot of your funding through debt, and if the interest rate environment is not good, you're not able to raise a lot of capital, and availability of capital is also scarce. You'll not be able to do a lot of LBOs at the desired rate of interest. So as low the interest rates are, the better it is for you as equity shareholders, because you kind of tend to make more of the returns after paying off the debt and the cost of debt. So you need to see the interest rate environment. You need to, of course, see the general partner that you are choosing. His performance or her performance is really important in the overall performance. His operating and financial experience needs to be seen. If he's a or she's a consistent performer, there are high chances that he or she will do well with you as well. Valuation methods used, you need to see that valuation methods that the private equity fund is using is as per the standards, is as per what how you would want the portfolio to be valued. So you need to see that. Incentive fee structure, very important. You need to see those clawback clauses that we discussed. You need to see that it's not extremely high, you're not getting penalized too much, on the incentive fee side. Drawdown procedures, you need to see whether the entire money is drawn down on day one, it follows a schedule, it's on demand, whether it suits your pocket, it suits your bank accounts, right? Whether you can deploy everything on day one. So all that you need to see. Now, how do you value private equity investments? There are a lot of approaches to it. I'm discussing three approaches to how a private equity investor would value a private company. First is the market comparable approach, is one of the most widely used approach. You kind of look at various deals that have happened in the sector, in the geography, in the sector, and you use those multiples to value your company. So that's first. Second is discounted cash flows, DCF method, where you value the cash flows of the company and derive the intrinsic value of the company by discounting the cash flows. And finally, we have the asset back approach, which is the book approach, where you value the net asset value of the company, which is essentially assets minus liabilities. So whatever is left for the equity holders, you calculate that. And there are various approaches in the asset backed approach also. Let's discuss them one by one. So as we discussed, multiples of financial metrics like EBITDA, revenue are calculated for comparable companies and transactions, and then you apply your financial metrics to that average. We'll see this in the next few slides, where I will basically tell you how to calculate this, how to go about using market comparable approach, but this is one of the most widely used approach. Now, this is the dividend discounting model, wherein you calculate the present value of the cash flows by discounting them. And you will learn this in the time value of money chapters as well. You basically calculate the present value of equity by discounting all the free cash flows to equity. And if you are doing the same for free cash flows to the firm, you will be calculating the enterprise value or the firm value, the full value, which is both to the equity holders and to the debt holders. Finally, asset-backed approach. Now, fair market value of assets or liquidation value can be used here. Multiple approaches. Liquidation values, are for companies which are under stress and are generally lower. NAV is value of assets minus liabilities, as I mentioned. So this is a approach which is essentially the book approach. The book, I mean the financial book approach. Now let's look at an example of market comparable approach. Say there is a company that we are evaluating as a private equity fund. It's a German company, and EBITDA and market value of five competitors. So I have written four, but this should be five. So five competitors is given, and we are basically looking at them. So these are five companies in the same industry as the company we are evaluating, and we are giving the market value and we are giving the EBITDA, right? And we are basically calculating the value of our company, which is in the same industry, using these financial metrics. And what else have we been given? We have been given our EBITDA, our company's EBITDA, right? 250 million euros. So what we'll do, we'll essentially calculate the multiple of market value to EBITDA for all these five companies. Then take an average. Since these companies are comparable, now what does one mean by comparable? One means that they are most likely in the same geography and most likely in the same industry. So whatever multiples, whatever market is valuing them versus their EBITDA should be the multiple that we should use for our own company to calculate the market value of our own company. So let's see how we go about doing this. So market value to EBITDA we have calculated for all these five companies. So we already know that this is at 5x, this is at 6, this is at 6, this is 5, this is 6. Then we calculate an average. So sum of this divided by 5, we get 5.4. Now this is the average multiple of the industry. We already know the EBITDA of our company. So we have EV by EBITDA of the industry, right? Or market value by EBITDA, as you may want to call it. EV is the enterprise value, same meaning the same. And if you multiply it with the EBITDA of our company, right? Of our company of interest, we will get the EV of our company of interest. That's simply what we are going to do. So 250 into 5.4, we get 1350 million euros, and that's the market value of our German company. Bases the data of these five European or German companies in the same sector. So that's how you use the market comparable approach. You calculated the comparable multiples of each one of them, then you used the average of that and you used it on the EBITDA of our company of interest. So this is the EV by EBITDA of the industry, and this is the EBITDA of our company, and we get the EV of our company. So I hope you really enjoyed the private equity section of this course, and you also learned how to value private equity investments from a private equity lens. And I'll see you in the next section. Thank you.